Hello options traders, welcome everybody. I just want to post another short video here on how to use some of the Greeks that we've been talking about, but to apply it in a platform. Depending on who you're using, most of the advanced options brokers platforms will have similar tools in them, and I would certainly encourage you to learn how to use them, because as you get more involved with strategies, you're going to find that these are essential for making decisions. They're going to show you when things are going to change quickly, or when possibly profits will start showing quickly. And unfortunately, a lot of times new traders just say, well, I've got a profit, I don't understand how the strategy works, so let me just close it. So for instance, I'm here in E-Trade, and let's say that I want, here we've got IBM trading for almost 145. So let's say we buy the 145 call, and I can analyze that, and you're going to see that you're going to get a profit and loss diagram, which we've seen before. The thicker line down here, the hockey stick shaped, is the expiration graph. And then the skinny curve right here is the current graph. And of course, that's going to change over time. Each day, that skinny curve is going to move closer and closer to that hockey stick shaped one until it actually becomes that at expiration. The blue line you're seeing here is the current stock price. Markets are not open now, but if they were, that blue line would move up and down with the current stock price. So it's actually a live graph when the markets are open. And what it's showing you is your various profits and losses at those stock prices. And of course, we can do some what-if scenarios. So let's just, to see it a little clearer, let's zoom in just a touch. So for instance, let's say that this blue line moves up to right here to this point. Let's see if I can move it up a little bit more. So the price that I'm pointing at right there in this orange box is 146.01. And it tells me that the option's theoretical price today would be $259, and I would be up $69.18 based on the trade that I'm looking at, which is right up here, buying one contract for $1.90. And of course, I can do some what ifs. I can say, well, what if the stock gets up here? Maybe I think this is where it's going to move today. Well, the theoretical price would be about $4, and I'd be up about almost $211. I can also say, well, what would happen at expiration if the stock hits 148? I can just drop straight down to this graph, and it tells me I'm going to be up about $3. So the difference between those prices, which is the difference between these two lines here, is time value. And that's why it has more value today than at expiration. What happens if the stock price falls all the way down to 142.60 today? Options theoretical price is $1.08. I'd be down about $81, $82. Now, where it gets really interesting is I can come up to this other tab here that's called Spectral Analysis. And most of your good platforms will have similar tools like this. They're very, very handy, especially for advanced strategies. I'll show you some in just a second. But what you're looking at here is the current stock price, just for last couple of weeks. And then this vertical line right here, where we get into this red and green box, is today's date. And it runs all the way through the expiration of the option that I'm looking at. And the red and green give you kind of a little legend up here as to what your profitability will be in terms of percents. I can also change it to dollars. So obviously, the darker the green, the better. And so I can see that I want to see the stock price go up. In this range is better for this strategy. Down is obviously going to be bad. Here it's going to be somewhere neutral. So it gives you a nice visual of what you want to happen. But I can also change the date with this slider right here. And as I just showed, I can change the price. But I can also click this little box here. I can go directly to the option expiration. I can go to the next earnings, next dividend if it was applicable, or I can actually type in an exact date and even down to the hour and minute. Can do that with the price over here. I can go to the current price. I can go to my strike, which is 145 in this example, to the 52-week high, 52 low, or I can, same thing as double clicking in there and just changing the actual price. I can make that number anything that I want. But what it's doing is it allows you to change price and time and to see where you are on your profit and loss curve right now. So for example, take a look down here in the lower left. This is what's called a spectral slice. And again, we've got our red and green color codes down here. I also have two vertical bars, and they allow me to pick two different stock prices. Normally, I'm going to use that for different strategies, different inflection points or strikes, expiration points that I'm curious about. And it will show me the probability for the stock to fall between or in these different ranges. So if you're curious to a particular strategy, how profitable it will be, and the likelihood this is where you'll find your answers. But now, more interestingly, watch this little red dot right there. That is the current stock price as indicated by this slider bar up here. Now watch when I move my slider bar down. See that orange dot moving down? It shows you exactly where you'll be on that profit and loss curve. Watch as I move the bar up. Shows me going up. So you know exactly where you are on your profit and loss graph at various stock prices and at various times. Now watch the box on the lower right. As I move the slider bar down, all of your Greeks are changing dynamically. So not only is it showing you where you'll be on your profit and loss graph, it's showing you what your Greeks will be at that point. And I can change time, and I can see how they're going to change. I can see when my gamma's possibly going to get very, very large. Or it might show where I'm hitting a point where I will start reducing the rate of gain in those deltas. It's an inflection point. I'm still increasing my deltas, but they're going to start slowing down. And depending on the strategy, that might be an important point to know. I can also, from this drop-down menu up here, I can choose individual Greeks. So if I choose delta, what you're looking at down here is no longer your profit and loss curve, but your delta graph. And for those who have had stats, you'll recognize this as a cumulative normal distribution. It's exactly why we can add the call and put deltas to come up to 1. But as I change my stock price, you can see that orange dot moving, and it shows you where your deltas, for example, right here, I'm going to start accelerating very quickly through my deltas, and up in here, I'm going to start slowing down the rate of growth in those deltas. But it gives you a nice visual. I can do it with gamma. Let's see what gamma looks like. There's my gamma graph. All right, so gamma is going to be peaked right here at the money, which we talked about. All of your Greeks are maximized at the money with the exception of delta. But I can also see the value of those gammas at various stock prices and where they're going to change if the stock continues in that direction. So pretty handy tool. Now where it becomes really handy is when you get into the more advanced strategies. It's not super hard with calls and puts, especially if you've been trading for a while and understand your Greeks. A lot of them you'll be able to just visualize. But watch what happens when you get into more advanced strategies. So for example, let's come up here and say we want to do a strangle. And let's see, let's get into something that's 5 points wide. All right, so just to make it easy, we'll do a 5-point wide strangle. The stock markets are now open, so the stock's just below 144. So let's say we want to do a 140, 145 strangle. And we're going to, let's see, actually, let's do this. Let's do a double calendar. I'm going to add a call, add a put. If we go 140 put, we would need to go maybe a 135 put down here, maybe a 150 call up here. And let's bring these out to maybe October, which would be pretty good. So here's a typical double calendar profit and loss diagram. And it's a good example because we're using calls and puts, long and short, and different expiration dates. So you got lots of moving parts in here. And now it becomes really difficult to understand what's going to happen where and at what dates and different stock prices. Now, one interesting thing to know about calendars and also doubles is that you're going to have a little bit of a curiosity when it comes to vega. Most of the time, if you have negative gamma, which you do here, we talked about that, you're got kind of this frown shape right here, which means we want the stock price to stay fairly neutral. We're going to start losing if it rises or falls too much. But usually if you have negative gamma, you also have negative vega, which also means we don't want volatility to increase, right? That's another way of boosting the potential for that stock's price to increase. But for this strategy, it's opposite. We have negative gamma, but we have positive vega. And that's because we own the longer dated options. So what can happen is if we get a pop in volatility, we're going to end up with a profitable position here that's not going to last through expiration. And further, we don't really want it to become more volatile. We want it to sit still. So that might be an indication that we should probably close the position. But how would you know without looking at these numbers? And this is why you have to understand this stuff. So watch what happens when we come down here into Analyze, go into Spectral Analysis, And now we can see definitely bright red areas if the stock price rises, bright red if it falls. And I can change the dates and the stock prices. And right about there, we're at the peak of our profit and loss graph. But what's going to happen to my deltas, for example, if the stock price rises? Watch your little orange dot down here. As it rises, I start going into negative deltas. Why is that? That's because this profit and loss curve is leaning left. And I talked about that in the deltas class. That's like a short stock position. And another interpretation is that you will need the stock price to fall in order to get to a more profitable position or to maximum gain. But watch what happens when this dot swings over to this side. In other words, if the stock price falls too far, we hit the peak, watch your deltas, they're going to swing from negative to positive. And that's because your profit and loss diagram is leaning to the right. We have positive deltas. And so another interpretation is that you need the stock price to rise. That will be beneficial for you. So we can see that right there in the graph. Let's take a look at gammas. Now I can go from positive gammas to negative gammas. And that's because we have long and short positions. It depends on where the stock price is. So if I've got negative gamma down here, up in here I'm going to start hitting positive gamma. And that means I need the stock price to move. Whether I need it to move up or down is told by delta. So just by looking at these numbers, I can tell that I need the stock price to move. I've got gamma, positive gamma, but I need it to fall because I'm basically short 19 shares of stock. If the stock price falls over here, I'm going to have positive gamma. I need the stock to move, but I need it to move up because I'm essentially holding 40 shares of stock at that moment. So the point that I'm just trying to show is it becomes really difficult to see and to visualize this stuff just because you have so many moving parts. Now watch your gammas as you get close to expiration. Watch these things really ramp up. We know that they're going to be negative. They're in the center. But take a look at that. That's a pretty good example, right? Let's see, there we go. You can get the deltas pretty close to zero, but look at your gammas. You go a one tick move in either direction of the stock, and your deltas are going to go from virtually flat to highly positive or highly negative. And that's why you have to be careful with positions like these. When you get near expiration, you've got very large positive or negative gammas. Positive gammas aren't so bad, they can swing in your favor, but negative gammas will go against you. But we'd still like to know that, whether we're long or short gamma. And this will tell you exactly where that's going to occur. So hopefully this gives you some good tips and some insights into why the Greeks are so important. Please continue to work them and understand them, because I know it might not make a lot of sense now, but it will when we get more into strategies. And when you get into hedging, rolling, morphing, this is what you're changing. We're going from one strategy to another, and you need to know what you're moving from and to. So you don't have to really understand the math of the Greeks. You don't really have to understand where they occur, because the charts will show that to you. But you do need to understand the information.